Hi there, I'm beginning our lectures on Chapter 4. Please read Chapter 4 thoroughly and please read the appendix to Chapter 4 thoroughly. That is our assignment for this week. I'm writing this on the 4th, so our next official module, Module 3, begins tomorrow, June 5th. Okay, so please make that reading happen. As usual, I'm going to give you a couple of videos to skim over some of the highlights, okay? So here is my PowerPoint. I will be posting this PowerPoint for you. We are talking about the stock market, also known as the equity market, which arguably in the United States, we have many markets. The most commonly known one, arguably, is probably the New York Stock Exchange. And that is quite possibly the largest and most well-known in the world of all of the capital markets. And again, this information I'm giving you, even though this is a business finance class, this is very important from the personal point of view as well, because if you're not already stock investing, at some point you should. Remember, I've illustrated to you already that because of inflation, you can't afford to not be investing and doing something more aggressively with your money. Okay? The stock market contains public ownership. Okay? When you have a company, as you learned in financial accounting, it can be owned privately. It can form as a corporation. It can issue stock. That stock might all be held by one person, two persons, 10 persons. Okay, but at some point, if the company decides that they want to be traded publicly, they go public, and all of a sudden, little pieces of the company's ownership are available for you and for me to buy in a public forum known as the stock market. Okay, there are many indices. There are several indices that follow the markets. Some of them are very specialized. Some of them have been with us a long time. The most common one here in the United States is the Dow Jones Industrial Average. When you hear people talk about the Dow, that's what they mean. They're referring to a composite measure of the 30 most well-known and representative stocks that are traded on the New York Stock Exchange. I believe there are about 3,300 different companies that trade on the prestigious New York Stock Exchange. More on that in a moment. Okay, if I have a company and I've developed it as a corporation, so all of my ownership is divided into a whole bunch of little tiny pieces. We call those shares of stock. Okay, I can decide that I want to get all your money and give up ownership to get it. So you will now become an owner. People own thousands upon thousands of shares in a company. But you only need to own one, and it gives you all the rights and privileges of being an owner. Okay? That is called the primary market. So I'm going to take my company, and using the help of the man or woman I mentioned to you in the previous chapter, the investment banker, they're going to develop a program for me so I can issue, issue my stock to you. And now you'll become an owner, and in exchange, you're going to give me your money. I don't like giving up my equity. I don't like giving up my ownership, so I better have a darn good reason. Usually it's because I want to take your money, a big slug of it, and I want to invest in heavy growth, acquisitions, many other things, okay? So again, it's very sophisticated. I don't know what I'm doing as the issuer of that stock, so I engage an investment banker, and they'll fill the role of underwriter, as I mentioned when I discussed indirect transfers in Chapter 3. Okay? They'll put together a stock issue. They'll recommend a price. They will write me a check for the amount of money I'm looking to raise, and they will then take my stock. I don't have time or knowledge to do this, and they will find all of you, the potential owners and investors that will buy this stock, and they will make their money back. Okay? All right, very good. So we're going to sell little tiny pieces of ownership, and those are called shares of stock. All right, now, as soon as I can choose to sell some of my stock to you privately. I don't have to do a public offering, okay? But if I make a public offering, then anybody can buy and sell shares of my stock. I won't get any of that money. I only get my money when the stock is first issued by me, and you give me your money. That's called the primary market. Okay, so you and I can deal individually with each other. More commonly, if I'm going to give up shares, it will be done through a public offering. Okay, what rights do you have? First of all, as an owner of the capital stock of my company, even with one share, you're going to have the right to a vote. Okay, you have the right to a vote. you don't walk into the company and start looking like Donald Trump on The Apprentice and saying, you're fired, you're fired. No, you can't do that. You can't call up Coca-Cola and say, give me the secret recipe, okay? So you do have limitations. But what your vote will do is influence the most important issues of the company. Generally, it's done once a year at least, and you will elect your representatives. We call them the board of directors. You'll probably re-elect your public accounting firm that does your auditing, and you'll vote on major issues such as merging with another company or acquiring another company, the big ticket items like that, okay? All right, very good. You will have, another right that you will have is you'll have the right to dividends if those dividends are issued, okay? Now, we'll talk about bonds in the next chapter. Those are like contracts. Ownership of stock is not. What is a dividend? A dividend, as you learned in financial accounting, is a distribution of past earnings, okay? So a company is going to earn money, profits, by its operations and build it and build it and build it, and use those funds to grow. Once in a great while, the company may decide, or shareholders may put pressure on the company to issue a little bit of cash to them as well. Some companies, well-known companies, don't pay dividends at all. So when you think of a dividend, think of yourself as receiving a little piece of past earnings, okay? There was an account that we learned about in financial accounting called retained earnings. It was an equity account. And whenever you close your profits, that's where the profits go to. It's an equity account, okay? So those retained earnings have to build up, and every so often the shareholders will get a piece of it. Now, can the issue of cash dividends be a bad idea? Remember, a company should always, always, always be growing, and that has to be fueled by cash. So whenever you receive a cash dividend, you might think, boy, oh boy, oh boy, this is found money, I love it. But I want you to stop and think, maybe that's not such a great idea, because that's that much more money that your company has given up. It can't get that back. It now does not have that money to fund its growth. So a dividend, when you look at it in a certain way, is almost like shooting yourself in the foot to some extent. It's like when I'm pumping my gas at the self-serve station and I'm looking at the meter spinning like crazy because of the high cost of gas, and I start using all kinds of colorful language about it. But then I stop and think, wait a minute, I own stock in ExxonMobil Corporation, so maybe I shouldn't whine so much, okay? Cash dividends are the same type of rationale, right? It's nice to receive a check, but that's cash that has been taken away from your company to reinvest in its own growth. Okay, so as a shareholder, you have the right to a vote. You have the right to receive a dividend if it's issued. It doesn't mean that it will be. Okay, and also, among other rights, you have the right to disclosure. You're going to receive the company's annual report, which contains the financial statements you learned to do back in accounting. You might receive also, or in place of those reports, a Form 10-K, okay? So once again, in accordance with GAAP, the company will have to disclose its status and the results of its operations once each year to you, okay? All right, very good. Bear with me, please. Okay, there we are. An IPO is called an initial public offering, and I'm just going to see if I've missed anything in the book. Hold on, please. All right, please read this entire section about the mechanics of how stock is issued, okay? There I mentioned the IPO, the initial public offering. Okay, now that is when I issue my stock to you, to the public, and you give me your money. All right, now once that stock is in your hands, it's going to be traded, bought and sold among you through the open market. Okay, now do I get any of that cash at all? No, I do not. That's called the secondary market, okay? In the primary market, I give you my stock, I take your cash. Right? In the secondary market, that's all up to you guys. The price of my stock could soar. You guys could trade it up to hundreds of dollars per share. I don't get any of that. Who determines that price? I'm going to show you in another chapter that we can determine it mathematically. But when you get right down to it, it's the rule of the marketplace. The price of my stock in the open market is going to be what you guys, willing buyers and willing sellers, will come together and agree upon. It's largely driven by psychology. Okay? So the IPO is complete. My stock is out there in your hands. All right, when the investment banker is making that happen, there are a couple of terms that we have to be familiar with. First of all, the investment banker has to price my deal properly. All right, he or she is going to pick a price for the stock. It's going to be a price that gets me the money I need, and it's going to be a price that will be low enough to induce you to buy it. So that's a clever balancing act that the investment banker has to follow. All right, the investment banker will publish one of these things. This is called a tombstone. Flip open financial publications or the Wall Street Journal, for example, and you'll see big things like this. My new company, MLDM, my investment banker is issuing 10 million shares, and she's priced them at $14.50 per share, okay? Obviously, I need to get my hands on somewhere around $140 million, and this is how it's going to happen. The investment banker may bring in a couple of other investment bankers, as you can see here, to share the risk. Every time another party gets involved, though, the profits from the investment banker's operations, they've got to share them with someone. And they may form a syndicate. They may find some other firms that will take on a little piece of the action. What's their job? It's to go out and find people that will buy these shares. Okay, because my investment banker is going to give me the $140 million I need for whatever my reason is. Now they've got my stock. They might want to sit on one little piece of it as a good investment, but they want their money back. So they want to push that stock out into the marketplace as quickly as they can. If they've priced the deal properly, then the shares will move. If they price them too low, the shares will definitely all move. But that's bad, because I'm going to look at the investment banker and say, you priced the deal too low, I left money on the table, I should have gotten more like $150 million. So they've got to please me as well as the public. Of course, if they price the deal too high and set the price per share too high, then they'll get stuck with stock in their inventory that they may not want to hold. Okay, so they do have quite a balancing act to perform here. So remember, primary market is when I get your money, when I first issue the stock. The secondary market, that's all up to you guys. Okay? All right, very good. I mentioned a couple of horror stories here. Please read these on your own. Just because a company is pre-positioned to succeed immensely doesn't mean that they will. Okay? Visa in 2007 went public for almost $18 billion. And they broke all the records at that point. Their shares subsequently went up to $191 each, $191 per share. Okay? Google went public at $85 a share. Now they're trading at 10 times that amount. Okay? Visa had the record for the longest time, and about 2 or 3 years ago, Alibaba went public, and I believe their public offering was higher, so I think they hold the record right now. Then I give you a couple of horror stories too. A fellow named Jim Collins wrote a book called How the Mighty Fall. I highly recommend it to you. Just because a company gets off to a great start or seems to have wonderful prospects, or both, it doesn't mean they'll stay that way. So please read this, and please understand that stock investing does bear some risk. Okay, what drives the stock's price in the market after the IPO? You guys do. Again, there's a math formula for it we'll get to later. Okay, the New York Stock Exchange, there are several physical location exchanges, I should say, in the United States and most definitely in the world. And when you watch the financial news networks and you're watching Jim Cramer or Maria Bartiromo, you see all this buzzing activity, it looks like an anthill, happening on the trading floor of the New York Stock Exchange, where you see celebrities ring the closing bell at 4 o'clock Eastern. Okay, that's a physical location. The trading, the bringing together of buyers and sellers through their representatives is actually happening there in a physical spot. There's another way that can happen too. The so-called over-the-counter markets, it all happens electronically. There is no physical location. The most well-known is probably NASDAQ, NASDAQ. I believe it stands for North American Society of, National Association of Securities Dealers Automated Quotation. That's what it stands for. My apologies. Okay, there are many brokers. Brokers are the people you'll deal with that will make the trade happen for you. But at the markets, themselves, you have to be a dealer to actually bring in the final equation to bring buyers and sellers together. A dealer is like a super broker, and generally the difference between a dealer and a broker is the broker will make the trade happen for you, a trade, a buy or a sell of stock. The dealer will hold their own inventory. So if you need to wait for your broker to bring buyers and sellers together, there might be a slight delay there. But if your broker is going through a dealer, that dealer can immediately satisfy your desire to buy stock right out of their own inventory. Or they can buy from you if you're looking to sell. Okay? Now the dealer is going to maintain, they're going to set and maintain a bid price and an ask price. Okay? The bid price is how much they're willing to buy your shares from you. The ask price is how much they want if you want to buy shares from them. Obviously, the ask price is going to be higher. Okay, the spread between the bid and the ask is one of the ways that a dealer makes their money. So please keep that in mind. Understand what the bid and ask prices are. All of this information will be found on or about page 70 in your text. Okay? So please understand what a dealer does and that they maintain their own inventory of stock, thereby allowing them to make a trade happen very, very quickly for you. Okay, capital stock. The two most common types are common and preferred. Up until now, I've been speaking about common. You learned about the differences in accounting. I will get into them in a moment. Please keep in mind that the right side of your balance sheet contains liabilities and equity. Equity is called a residual claim. Creditors, in other words, liabilities, have legal priority. So if a company is dissolving voluntarily or involuntarily, all liabilities to creditors have to be satisfied before the owners get everything. For that reason, we refer to it as a residual claim. All right? If a company is troubled and is forced into bankruptcy, chances are there's not going to be anything left for the equity holders at all. Otherwise, the company probably wouldn't be in bankruptcy. Okay, the types of stock. Common, that is the most basic ownership right. It is lowest in the food chain, okay? They come after absolutely everybody for dividends, for getting something if the company liquidates, okay? The common shareholders, they eat last, okay? There are always people in line in front of them. If the company also happens to have preferred stock, they are superior to common shareholders, usually with respect to dividends, okay? So if the board of directors issues a dividend, the preferred shareholders get to jump to the front of the line and they get their money first. If there's not enough money to go around, then the preferred shareholders get theirs and there may be nothing left for the common shareholders at all. Okay, so preferred shareholders have a little bit less risk. It looks like they're in a sweet spot. Usually when you take on less risk, there's less reward. So how does that work? I'll show you why later. Okay. Actually, being a preferred shareholder is great up front, but later on it could have its limitations. Okay? Here's an illustration for you. This company, Vadnais Corporation, does have preferred stock. Okay? It issues 10,000 shares total of preferred stock, and this preferred stock is cumulative. Most preferred stock is cumulative. That means if no dividend or a partial dividend is declared in any year, then obviously the preferred shareholders aren't going to get everything they're entitled to, but the company can't forget about it. Any unpaid dividends for those years that something, all or partial, were missed, that has to be held in arrears and caught up in future years before the common shareholders get anything. In other words, we've got to bring the preferred shareholders current right to today before the common shareholders get a piece. That's what the word cumulative means. Not all preferred stock is cumulative, okay, but this stock in Vadnais Corporation is, okay? So please note this. When you have preferred stock, you know right up front what kind of a dividend per share you will get. Not so with common, okay? That's at the discretion of the board. But if you own preferred stock, you're going to know if a dividend is issued, how much you're entitled to receive. In this case, it's $50 a share. That means that every single year, the preferred shareholders are entitled to a total distribution, if one is declared, of $500,000. Okay? So in this problem, I want you to describe among the preferred shareholders and the common shareholders who gets what and when. Everything in this problem you will find on page 71. Again, this lecture is not intended to replace reading. It's only to bring out the highlights. These video lectures are partial, okay? But I am going to try to focus on the most salient points. My time right now is up. I'll be back with another one possibly later today, definitely on Monday. Enjoy the rest of your day. Bye-bye.